our top story today. Federal Reserve Chair Jay Powell signaled more rate cuts are not likely at the moment. Powell said the current level of interest rates should sustain the economic expansion in the U.S. That was in a speech he gave in Providence, Rhode Island late yesterday. I want to introduce this hour's panel to discuss Alex.FYI CEO Ramsey Smith and Yahoo Finance's Rick Newman. And also joining us from Irvine, California is Allianz Chief Economic Advisor Mohamed El-Erian. Mohamed, it's great to see you. Even as Jay Powell gave that speech last night, you were out with an opinion piece on Bloomberg where you talked about the tension between the Fed's trajectory and the markets right now. If the Fed is on hold, how long will the markets sort of allow the Fed to be on hold? What do you think?
So I think increasingly the markets are starting to put pressure on the Fed. It is less than what we've seen in the past, and for good reason, Julie. The Fed has pumped in a ton of liquidity over the last few weeks. They don't call it QE, but for the marketplace, it's the equivalent of QE. So even though we've had massive injections of liquidity, we're starting to see, pressure on yields and pressure on the yield curve.
Mohamed, it's Adam Shapiro. Good to see you. Help us understand something when you talk about the pressure the market might put on the Fed. Powell apparently is concerned on not raising alarm bells about a deflationary, I don't want to say deflationary spiral, a drop in asset prices. And then we get a reading today. Consumer confidence is down, but even more so, the median new house price fell 3.5% year over year at a time when interest rates have come down. So help me understand what's really at play here, because it seems as if the Fed will be pressured into trying to once again inflate assets.
Yeah, Adam, what's in play is an imperfect way of trying to promote economic prosperity and financial stability. So we should be pursuing genuine drivers of economic growth. We talk about infrastructure. We talk about things that really drive an economy higher because they promote productivity. But we haven't had that for a number of years, especially in Europe. Instead, what we've had is central banks. And how do central banks pursue their economic objectives? By pushing up asset prices, by hoping that higher asset prices make us feel wealthier. And as we feel wealthier, we spend more. And as we spend more, companies invest more. But guess what? It doesn't work. And there are increasing collateral damage and unintended consequences. So what you're seeing here is basically the Fed pushing on a string. However, the Fed cannot pull back, because if it pulled back, it's worried that it's going to disrupt markets. And if it disrupts markets, there can be a spillover on the economy. So they're in a lose, lose, lose. They can't stay where they are. They can't do more, but they can't do less. And that's the irony of relying for too long simply on central banks.
So, Mohamed, this is Ramsey Smith from Alex.FYI. So what are the long-run implications here? So we're in a bit of a trap, and the central bank continues to lower rates. What are the long-run implications for the economy?
So first, short-term, this is great for investors. I mean, how often do we get the trifecta of high returns, not only on your risk assets, but also on your risk mitigation assets, on your bonds? It's great. Everything goes up. Secondly, no volatility. Look at the VIX. We're back at 12. We may well go back to 10. And thirdly, as I said, correlation, you get paid for risk mitigation. So for investors, it's wonderful. However, at some point, we need to transition. We need to hand off to genuine drivers of growth. Otherwise, we're going to find that the gap between asset prices up here and fundamentals down here is too large. So the hope, and you see it in the marketplace, the hope is that we get a policy handoff. What does it look like? First, solve the trade tensions. Secondly, Germany implements fiscal stimulus. Thirdly, we get an infrastructure effort both in the US and Europe. I think the optimism is too high, but that's what's priced in right now in the marketplace.
So there's optimism perhaps too high that there will be proactive measures on the parts of those various parties you're talking about. There's also perhaps too much optimism that one of the obstacles to growth is going to be removed. I'm referring to trade here because the latest report we got, Mohamed, is that top negotiators from the U.S. and China had another phone call last night. That was according to the Chinese Ministry of Commerce, and the two sides agreed to remain in contact. So what do you make of all of this trade back and forth? Rick Newman, who's with us on set, has been documenting the president's unflagging optimism about the situation that has been going on for about a year now.
So it's the interest of both sides to continue talking. It's the interest of both sides to de-escalate for now, because in the short term, neither of them wants a market disruption. However, why is it taking so long to get this mini deal? And it's taking so long to get this mini deal for two reasons. One is that there's lack of trust and lack of verification. So they're trying to figure out that once they agree, how are we going to actually get outcomes? But secondly, and most importantly, the mini deal doesn't address some of the bigger issues. And these are going to come back. There are genuine grievances about the way China approaches trade. There are genuine grievances about the way China treats American and European companies. These things aren't going away. So at best, we're going to get a mini deal that will see a truce through next year, but we are going to see a re-escalation of trade tensions.
Something else that's getting a lot of attention was the Wall Street Journal article this morning about the loss of venture capital, perhaps, for startups. You even tweeted portions of the article. The companies like WeWork and Uber have lost over $100 billion in value this year, prompting some startups to talk about profitability over growth. What do you think is the conversation we need to hear from startups to get us and to get the big money interested once again?
So I think WeWork is a perfect example of what we need to talk about. One, with so much funding available, because interest rates are so low, it pushes investors and venture investors to basically flood these companies. One, can you handle growth? Two, do you have the right governance system in place? And three, can you address the inevitable potholes that occur when a small startup deals with more and more issues? You have to change the way you do things. And WeWork failed on all three. And in the process, all the strengths of WeWork turned into weakness, including the founder-based model. So it's really important for investors to ask these questions because funding will remain ample. People are in great search for returns. But WeWork, Uber, and many others show you that there's a limit to how quickly these startups can grow. And I think it's healthy to have that discussion because startups are critical to the economic dynamism of the United States.
And of course, Mohamed, most of that capital is still private, with the exception of things like Uber and Lyft that have now come public. So are we going to see a broader re-rating of these startups? WeWork aside, which is an extreme case, right? Are we going to see a re-rating? And are there going to be implications for investors, for 401ks, for example, for big funds that have at least some of their money in venture or in private equity?
So for the average person, venture is a pretty small part of their retirement plan. So if you are, a teacher, if you are a state employee, yes, your plan has venture exposure, but it's not that large. It's a different issue if you are one of these sophisticated investors and you've gone straight into venture funds. And what you're going to see, I hope, is a good discussion about valuations. What we've learned also from these companies that you've listed and also from WeWork is that private valuations get decoupled from public market valuations, so that when you have the transition from private to public, there's a shock involved. WeWork, look how much the valuations fell when it came time to refinance the company. So I think what you're going to get is a better discussion, a better conversation about valuations, but it is a really difficult one.
Yeah, definitely. We've seen that play out in real time. Mohamed El-Erian, Allianz Group Chief Economic Advisor. It's great to see you as always, Mohamed. Happy Thanksgiving to you.
And to you, thanks for having me on.
Thanks.